Welcome to week 2 of International Finance. I'm Dr. Mark Dennis, and I'm looking forward to diving into this week's topics with you. In this session, we're going to explore currency derivatives, purchasing power parity, and some different types of exchange rate risk. These concepts are critical for understanding how multinational corporations manage financial exposure in a global economy. Let's get started. Let's start with the basics. What exactly is a currency derivative? A currency derivative is a contract where the value comes from the price of an underlying currency. Think of it as a financial agreement that gains or loses value as exchange rates move. Two common examples are forward or futures contracts and currency options. Multinational corporations use these instruments for two main purposes. First, to speculate, essentially betting on where the exchange rates are likely to go next. Second, as a hedge, which means protecting themselves from potential losses if exchange rates move against them. The forward market is where forward contracts are traded. A forward contract is a private agreement between a corporation and a financial institution to exchange a specific amount of one currency for another at a set exchange rate. This rate is known as the forward rate, and it will occur on a future date. This is similar to making a deal today to lock in tomorrow's price, which can provide certainty and protect against unwanted exchange rate swings. So how exactly do multinational corporations use forward contracts? One way is to hedge imports. If a U.S. company knows it will need to pay a supplier in euros 3 months from now, it can lock in today's euro rate with a forward contract. This way, even if the euro gets stronger, the company pays the agreed upon rate. Banks quote forward rates with a bid-ask spread, and this spread is typically wider for less liquid currencies. In some cases, companies may arrange an offsetting trade. For example, if they've agreed to buy a currency forward, but they later need to sell it instead. For currencies from emerging markets that are not easily delivered, companies may use a non-deliverable forward or NDF. In this instance, no physical currency changes hands. Instead, one party pays the other based on the difference between the agreed rate and the actual market rate at settlement. The currency futures market is very similar to the forward market, but with some important differences. Like forwards, currency futures are also agreements to buy or sell currency at a set rate on a future date. Unlike forwards, which are private, customized deals, futures contracts are standardized in terms of contract size, settlement dates, and other terms. This standardization makes them more liquid and easier to trade. Most currency futures are based on the US dollar, although cross-rate futures are also available. In the United States, the Chicago Mercantile Exchange, or CME, is a major trading venue. trading currency futures can be done through brokerage firms, either over the phone or through electronic trading platforms. These platforms act like middlemen, executing trades between buyers and sellers quickly and efficiently. Futures, just like forwards, let you lock in exchange rates for a future date, which can be valuable for both hedging and speculation. One thing to keep in mind with currency futures is credit risk. The Chicago Mercantile Exchange, or CME, addresses this by requiring margin deposits. When you take a position in a futures contract, you must put up a certain amount of money with your broker. This deposit covers potential losses from daily price changes. In terms of pricing, futures rates tend to be very close to forward rates, and both contracts serve a similar function, giving businesses the ability to set a known exchange rate ahead of time. Now let's look at the currency options market. Currency options give you the right, but not the obligation, to buy or sell a currency at a set price. These can be traded on regulated exchanges such as the CME Group, or over the counter through banks and brokers. Exchange-traded options are standardized, while over-the-counter options are tailored more to the buyer's needs. A currency call option lets you buy a specific currency at a set strike price within a given time frame. If the spot rate rises above the strike price, exercising the call lets you buy at the lower agreed upon rate. The buyer pays a premium for this right. A call is considered to be, quote, in the money when the spot rate is higher than the strike, and at the money when they're equal, or out of the money when the spot rate is lower. Companies use call options in a few ways. They can hedge payables in foreign currency, lock in costs when bidding on projects abroad, or secure favorable rates for potential acquisitions. A currency put option is the mirror image of a call. A put gives the holder the right to sell a currency at a specified strike price within a set time period. If the spot rate falls below the strike, the put holder can sell at the higher strike price. As with calls, the buyer pays a premium. A put is considered quote-unquote in the money when the spot rate is lower than the strike, at the money when equal, and out of the money when the spot is higher. Multinationals use put options to protect against foreign currency depreciation. For example, if they expect to receive foreign currency payments in the future, a put locks in today's rate to guard against losses if that currency does indeed happen to weaken. Deep out-of-the-money puts are cheaper but less likely to be exercised. Puts with strike prices above the current rate cost more, but these offer stronger protection. The contingency graphs for put options show how buyer and seller payoffs change with exchange rates. Buyers benefit when the currency falls below the strike price, minus the premium they paid. Sellers keep the premium if the currency stays above the strike, but they risk losses if it drops too far. Overall, research suggests that once you factor in transaction costs, the currency options market is generally efficient. Purchasing power parity, or triple P, helps us understand how prices and exchange rates are connected. The absolute form says that without trade barriers, identical goods should cost the same everywhere once converted to a common currency. The relative form recognizes that markets are not entirely perfect. Prices may differ, but the rate of change between countries should be similar over time. Under relative purchasing power parity, if prices rise faster in one country than they do in another, consumers will shift purchases toward the cheaper market. This shift in demand puts pressure on exchange rates until purchasing power is balanced once again across countries. We can derive a purchasing power parity relationship between inflation and exchange rates. If the home country's inflation is higher than the rate abroad, the foreign currency should appreciate. If the foreign country's inflation is higher, its currency should depreciate. This is why tracking inflation differences is a useful way to anticipate currency movements. In practice, relative purchasing power parity is used to estimate exchange rate changes from inflation differentials. Because trade links economies, a higher inflation rate in one country typically leads to a weaker currency over time. A simplified rule of thumb is that the percentage change in the exchange rate should roughly match the inflation gap between countries. Exchange rate risk is the chance that currency movements will hurt a company's cash flows. By managing this risk, multinationals can smooth out earnings and protect their stock value. While some theories suggest exchange rate risk might not matter, in reality, few companies operate in a world without currency impact. Many companies acknowledge exchange rate risk in their reports. For example, Facebook, now known as Meta, notes that a stronger US dollar can reduce its reported revenue from overseas. Procter & Gamble cites the impact of currency swings on both revenues and expenses. PepsiCo warns that currency volatility can harm its business results and overall financial condition. Transaction exposure focuses on the impact of exchange rate changes on contractual cash flows in foreign currencies. Companies measure it by estimating net cash flows in each currency, assessing volatility, and considering how currencies move in relation to each other. Economic exposure, also referred to as operating exposure, looks at how currency changes affect all future cash flows. If a foreign currency depreciates, both inflows and outflows could fall. If the currency appreciates, both may rise. Companies often test different exchange rate scenarios to understand any potential impacts. as our final topic for this session, translation exposure is about how currency changes affect a multinational's consolidated financial statements. This occurs when a company's foreign subsidiaries hold assets and liabilities in a local currency that fluctuates against the home currency. The greater the share of operations overseas, and the more volatile those foreign currencies, the larger the translation risk. This concludes part 1 of the Week 2 live chat. Tune in later this week for more.